So because there has been a lot of discussion regarding market, and I mean the way market has moved in last 5 months from March when there was value, but quickly it has moved and a lot of discussion is happening. And I think 1 week back I did make a video, but that was restricted to Nifty 500 index and Nifty 500 company, where the composition and the share of Nifty 50 companies is high. And also, I didn't cover all the angles, and I did mention please take this analysis only for Nifty 500, not for small cap and mid cap. And the bigger discussion of froth is happening around small cap and mid cap. So I thought I will spend some time and give an idea of where we stand on each of these indices. Please use this information for the learning framework about how to evaluate market cycles, and then use these learnings, but act on your own analysis. So if we look at the long-term investing market cycle, typically it's a cyclic thing where, if you start from anywhere, you can start. So let's say if currently we are in a market where market is running up, everybody is happy, everybody's portfolio is doing well, nobody's complaining. And then slowly we will reach to a stage where valuations might become frothy and against the possible growth, because it's growth versus valuation. And when the probability to succeed becomes very, very less, that is where the intelligent money starts selling off silently. Intelligent money doesn't need to be big money, doesn't need to be small money. I mean, it is the money which understand the pulse of the market in terms of attractiveness, and they decide. And ultimately, some of the big guys who are intelligent, they build charts and they start exiting, and that is how chart shows stopping pattern, charts start weakening. And then for long-term investors, techno funda investors, for traders, those who rely on chart as a signal, charts also start generating sell signals. And then market undergoes correction, then it keeps falling, and then a time comes when the correction gets over, it stays in that downfall move, correction done, and slowly fundamentally values start emerging, and some again intelligent money which doesn't care about the momentum and care about the trend, but they know there is value in this market and they're willing to let their money underperform for some time. They start building their position, and slowly the intelligent money starts buying it, and then again the market moves. There is a broader participation, there are more people getting into the market keeps going up, and the cycle continues. This is the typical cycle. The big question which is there is, nobody would disagree that we are not here. I think we all will agree that we are here. The question is, have we crossed this and have we come here, or have we come here? Of course, we are among one of the three, because with a basic analysis of chart, right now there is no topping pattern visible on any of the chart. Very, very strong momentum is there. So we could be in one of these three phases. The question is, where are we? And that is where we will try to look at the data, and we will try to see if we are getting a clues, where are we? And one thing, so what I have tried to do is, see, most of the times we use an indicator and public get excited. Even today I put a tweet and it creates a lot of excitement. But one message I want to give is, never ever rely on one indicator. If a market was all about predicting or reacting well with one indicator, everybody would have had that golden indicator and everybody was a boss in the market, but it doesn't happen that way. So we need to look at multiple things, multiple views, multiple data points, which can bring different value to the table, and try to triangulate. And when most of the things suggest the same thing in the same direction, the probability to succeed increases, and then we can take probabilistic bets. So I'll try to give you different perspectives based on quants, perspectives based on fundamental, perspectives based on technical, perspectives based on market sentiment, Google trend, all of that. And then we will try to see, if we combine all of that, where do we stand on overall market, on Nifty 50, on mid cap, on small cap. So that's the process we are going to follow. So first, let us start with the quantitative view. And this is something which will come in Simba slowly in the market page. So right now in Simba, the market page is blank. And if you see Simba in terms of whether we are studying the index page or stock page or sector page, industry page, it's more a representation of momentum. but slowly Simba will have value also. Right now I have in Excel sheets, I have taken out from the Excel sheets, I am presenting here, but sooner or later the market page of Simba will have that value analytics representation. Now, if you see this, I have given you a data of last 5 years by month, and this is the overall market, and you can call it, it's a momentum heat map. So when your scores are very, very low, it means the momentum is totally missing in the market, but this is where the value emerges. Now, it might take 6 months for value to emerge, it might take 8 months, 10 months, whatever. And when the score starts going high, that means from bottom of the market is getting into uptrend, then the uptrend continues, then it starts hitting up, and then froth starts building up in the market, and again you go through a correction cycle, again same thing repeats. So this is how the market behaves. Now, if you look at this number, 74%, even if you look at the last 5 years, and usually it will be around 70 to 78% kind of number looking at 10-15 years of data. But if you look at this number, around 74% was peak in last 5-6 years. Currently, we are almost near the 80th percentile at an overall market level. This score is around 61%, which means first, I mean, nobody knows where the market will retrace, whether it will continue or it will go back from here, nobody knows. But if we think in terms of probability, we still have ground to be covered from 61 to 74%. Also, we need to understand the context of this 74% being created. So we should never just look at the data, but we should also look at the context. And that is why I will try to give you multiple dimensions of data. This came after 1.5 years of bull run. This has come after 6-7 months of bull run. Now, there are two possibilities. Few months of move, maybe 6-8 months of move, and we top out, or the earnings keep the market higher and higher. This is something which has happened in 2005 to 7 cycle. Somebody was putting a RSI that, last 10 years, RSI, if it is crossing 70, if you go and see 2008, 4 to 7 cycle, if somebody would have just taken RSI, it was always there. You would have missed the whole move. So we have to take the possibility of each and every scenario, even if it is an outlier scenario. We have to take the possibility and we have to see what are the chances of outlier playing. So these are the two possibilities I see looking at this data. So first point I will make, even if you take the 2021 data, so there you saw the scores started worsening, like June, July, you hit the peak of 74%. Now I'm giving you one more data point, which I shared today. Percentage of Nifty 500 companies above 200-day exponential moving average. The higher the number, more the number of stocks in the market which are in uptrend. And as this number peaks out and starts coming down, it says more the market is getting weaker, and maybe still if the index is going up, few stocks are moving the market up. Now, even if you look this data for the whole 2021, it touched almost 85% in January. Some correction again went up, and it took almost 7 to 8 months. So just this number touching up doesn't mean that, tomorrow correction will come. We have to look at this number in terms of context, in terms of direction. And the last peak got created around 90% in June. But despite of that, from June to January, still, if you look at Nifty 500, it went from 13,600, or maybe June. Yeah, this is the June period. From 14,000, it went almost to 16,000. So still, you got almost a 15% move, which is because sector rotation, few players running the market, people say Nifty managed or whatever. But few stocks also have capability to move the market. So what I want to say is, just because you look at this number 90%, it doesn't mean things will, go haywire in 1 month and the whole market will crash. It has its own cycle and way to manage, but we have to keep looking at the direction, momentum. We have to keep looking at more data. We have to keep looking at charts. So make a note of this. Now, if we go back to the first scenario, as I said, it might take 6 months to 8 months. It is not going to happen, and it might happen in 1 month also, nobody knows, but don't get surprised if it takes 6, 8, 10 months for this behavior to repeat. Let us say the second scenario plays out, that if the market is really doing well on the EPS growth in terms of quarterly result. So this is the result of Q1 FY24, where I have cleaned the data. I have got rid of outliers, companies which are in heavy loss, made profit, some life insurance industries where there is too much of accounting here and there. So some 3-4% companies got removed, and it was much more cleaner data to do a balanced year-over-year comparison. This is from top 200 companies. Q1 FY24 revenue year-over-year growth rate was 10%. PAT year-over-year growth rate was 19%. PAT margin last year Q1 was 10.4%. This year it's 11.3%. The balance sheets are much more stronger. If you look at the same number for different indices, for all the companies, almost 3,500 plus companies, revenue growth almost 9%, EBIT growth rate almost 33%. If you look at Nifty 50, it's 11% and 33%. Mid cap, same. Only small cap, this number is very, very poor. What it highlights is the EPS growth rate in Q1 has been very, very healthy. And if we see 2003 to 7 type of bull run, I know everybody has been talking past 13 years, 15 years has come, but there could always be a possibility. Now with a 19-20% kind of growth rate, markets look for growth, and most of the times, even in stock, you will see the stocks which can keep growing at 20-30%, the PE will keep on stretching, it will keep remaining high. It's only when the growth falters and PE has taken too much, then PE falters and the correction happens. So we have to look at what is the valuation metric and what is the growth and how much can happen. That balance has to go. So whatever froth indications might come from a lot of those indicators, we have to be cognizant of the fact that at least from 2010 till 2020, we haven't seen a lot of quarters where a 20% EPS growth has happened. So if we get, and we don't know what is going to happen in Q2, Q3, Q4, but this is what we have from Q1. So if same kind of growth continues, then we need to, we need to be very agile. We need to go quarter and quarter rather than having a view that market has stopped or this is India's decade for 10 years. But this is a view we cannot ignore and we have to look at it. Now it becomes more interesting. So earlier the heat map which I showed you, that was for overall market. Now I'm breaking that heat map separately for indices. Now when you look at the same heat map for Nifty 50, there is no froth at all. So if you look at Nifty 50 in 2020, this is how it bottomed. And in 2021 December, this is how it topped. And then of course, 2022 was a challenging year. And then again in the March, it went around 27% zone. Again, we reverted. We are nowhere close to the 70% number. Forget, we are not even in the mid of 50%. This is 43%. And I think some of the accounts I track, there is a person, mutual fund distributor, Sandeep, a very interesting, very knowledgeable person. He coined a term, Ritik. I mean, I don't know he coined or whoever coined, but Ritik stocks like HDFC and Reliance and all. If you look at a lot of big banks, they have not performed. It's not that valuations are frothy. The TCS and the Infosys, the big IT companies, they have not performed. So that could be reason, whatever be the reason, but there is no froth in Nifty 50. But when you break this data and go down the market capitalization curve, now what I am showing you is this is mid cap and this is small cap. This is mid cap 150. I'm sorry, this is not visible. And this is small cap 250. Similar kind of things here bottomed, here topped, and that is why again those who are part of practitioner from last 1.5 years. In fact, I plan to make a video of all the comments done from January till now, so that even people, those who have joined new, they will learn that whatever we did, with what merit we did, why we did, what worked, what didn't work. That will be a good learning. But you know that we have been a little bit cautious of the small cap, try to hide in the index funds and all of that, and then slowly turn bullish, whatever. And it highlights the same. So there was a rationale around it. If you remember, I used to share some of the numbers. That time we didn't have Simba to share in terms of, these kind of, heat maps and all. But this is how we topped. And then again, slowly in June, you saw this score becoming attractive. And then again in March, this score becoming bit attractive. But right now we have hit 61% band, but this is not like the peak of the world. And same in small cap, we have hit 64, but you can see there is a froth building right now, and very, very quickly. One reason being, so one side of argument is here you had come after 1.5 years of correction, 1.5 years of bull run, whereas right now you are just coming out of a correction. But the counter argument could be, here you came out of 1.5 years of bull run, which was followed by the huge correction. This is a reflection. Here it was not so huge. So thing is, people who have to give argument, they can give arguments. Ultimately, the arguments have to be won over data. And mentally, even for human, even though we have so much of insight, if I ask you to compare, can you compare this with this? It becomes humanly a little difficult. So this is how things are there on probability. But what is certain is, for sure, this is not an attractive market. For sure, there is some amount of froth. We are hitting the 70-80% kind of from the peak levels. We have to live with it. This is a reality in small and mid cap space, but Nifty 50 is very, very different. So if a diversion happens, we should not be shocked like what happened in 1819. If that happened, we should not be shocked. So this is one way to look from a momentum indicators. Let's look at the price value indicator. So again, I have made a lot of YouTube videos, using some of these indicators. The broad idea is, we know in the long run, whether it's Nifty, small cap, mid cap, all we get is 10 to 14% return, mean being somewhere around 12-13% return. So if you have a long-term return, which is very, very far, the whole concept of reversion to mean and standard deviation, if your current long-term returns are very, very far from that mean, if it is very, very low, then you might expect a good return from here. If it is very, very high, you might expect a low return from here. Again, there will always be outliers. It might be possible few months of high, despite of a high lag return, still you have a high lead return. How we plot this? So there is a concept of lag and lead. What lag says, what has been my 3-year CAGR if I would have invested 3 years back versus now? And lead says, if I invest now, how much CAGR I am going to generate after 3 years. I run a scientific investing community where we run this practitioner membership program where we meet weekly, and there is a whole repository of content. Many of you think that the work we do is all YouTube work, but what is there on YouTube is hardly 5% of the work we have done. Do go and check the practitioner page. Do check what we cover under those 16-17 courses. And there are a lot of company case studies, sector case study, industry case study, valuation case study, technical analysis case study. So much of work we do. We connect on a regular basis. We do meetups on a weekly basis. So do check the practitioner program. So if your lag is very, very high and your historic mean is 12%, the lag is 30%, the chances are next 3 years might be 5%, 6%, and hence the overall mean return will come back to 12%. Or if the last 3-year lag return has been minus 1% or 1%, the chances are next 3 years will become 20%, 25%, and again the mean will become 12%. That's the logic. But it may not play exactly in the same way. There could always be outliers. I'll show you through some examples. Now, if we see the Nifty data for 3-year and 5-year, because we had a COVID and market crashed and went up. So it's always good to look at pre-COVID, a 5-year view, 18-23 and 22-23. 1 year will be too much of spikes and all. It doesn't make sense. So I'm taking 3 and 5-year view. If you look at the last 3-year return of Nifty, CAGR has been around 20%. And if you look at last 5 years, has been around 12%. So 12% 5-year and giving more weightage to 5-year because we had COVID and COVID things crashed unnecessarily. A 5-year 12% return is nothing where there could be a froth. So first indicator you saw at a Nifty level, 43%. We have not yet hit the frothy level. We are maybe in the middle. This return is also near the mean, which again says there may not be froth. But last 3 to 5 year returns have been fair to good. So we should not have an expectation at this level. Maybe if we are getting 8 to 10, 12%, we should be happy. But more than that, I think really the companies need to do well on the EPS growth rate and all to make money. That is how I'm sensing it. And when we are at extremes, the humans, we do the opposite. Whereas we should do what the charts are telling. So when we get this kind of scenario, we should go and we should buy aggressively, but that time we get scared. So that is why I use all these things to show that, look, history says that, when you go and buy, there is blood in the market. Hell with technical analysis. If you believe in the country and if you believe in GDP and growth rate, technical analysis is just a reflection of what intelligent people are doing. So we should know when to avoid technical and when to embrace technical. That is a bigger skill than learning technical analysis. Of course, finding that base all is okay, but beyond a point, we have to participate when there is a bloodbath. If we are a value mindset guy, if we are a momentum mindset guy, it's okay. But if we are a value mindset guy, we cannot apply technical when there is bloodbath. At certain point of time, we have to be intelligent and courageous enough to take those things, and data proves it. I mean, all catch the falling knife, don't catch the falling knife, all sided part. Now, if we look at this data for a mid cap, last 3-year return has been almost 30% plus, despite of all that correction. Actually, when the correction started, it was almost 40%, and that is why we see this number coming down. And even on a 5-year basis, we are somewhere around 18%. So almost 18 to 30% CAGR we have generated against a historic mean of 12%. I don't want to deny that last quarter results were very, very good. We should keep a track on the results. But if something can keep it beyond the mean, it has to be EPS growth driven. If EPS growth falters, then I think we will revert to the mean. The only thing which can keep it up and up and up is the EPS growth performance of 20% kind of. And if you look at this data, like if somebody invested in August 16, when you see the 3-year data, your lead return was 30%. The next 3-year return, August 19, was very, very bad. Same thing if you look at 5-year data, but there are certain instances, like let me show you. Here, the lead return, the 5-year lag return is 20% in June 18, because 13 market was highly attractive. 11 to 14 market didn't move. So 13 was an attractive market, and 13 to 18, you got a very good return because 13 started from the bottom on valuation and Jan 18 was the peak of the valuation. So basically it's a 5-year cycle from very attractive market to a very overvalued market, and hence you hit this level of 24%. And if you can look at this return is hardly 3-4% from April 18 to April 23. But because you topped out in Jan 18 and in March 23, you went through almost a 25-30% correction on small caps. But if somebody participated just for last 5 months, this has gone up from 5% to 10%. This is what last 5-6 months have done. This is what I want to highlight. And here, if you see, despite of last 5 years being at 23%, now we are at 13-14%. So that is what I am telling. Even if it is more than 20%, don't be 100% sure that this number will become less than 10%. Those kind of scenarios are possible. But on a probabilistic basis, the chances are lesser, and despite of that, still our return is hardly 14%, despite of this massive last 5 month of move. And if we remove that 5 month of move, then of course it was very, very bad. So this is how we have to look, that last 3 to 5 years have been good for small cap index, 15 to 30% kind of CAGR, whereas the last 3-year historic mean is 12%, 5-year historic mean is 9%. So the expectations should be accordingly, and surely there is some level of froth which is building. Again, there in the heat map, we saw we are hitting the 80 percentile. Here also, we are seeing it. Now, given we have covered these quant metric, let us look at valuations, where we stand in terms of valuation. Now, again, we cannot simply rely on single metric like PE. If we rely just on PE, there are times like COVID where the PE was inflated because the EPS was down. Or if we just look at book value, if there is a sector which works on an asset light model, of course, the book value will be high. We cannot just rely on EV/EBITDA. And if you attended the valuation lecture, and most of you join, when you receive the mail, I tell to go and watch the valuation lecture. Each and every metric has its own pros and cons. So what you are seeing here is a blend of multiple metric, which I have tried to combine just to see when we combine everything, where do we stand? If we look at some of these things. Again, from a fundamental valuation metric, the mean, we are not very, very far. And the way to read this number is, if this number is in green, positive, that means it's attractive. If it is negative and red, that means it's overvalued. Now, if you look at Nifty 50, we are not very, very far, maybe little bit high from fair valuation. And one more thing you notice, the 80th percentile deviation from 80th percentile and mean, it's very, very close. This itself says Nifty is relatively very less volatile. There is not lot of difference between your mean valuation and your 80th percentile variation. I was also surprised that last year when Nifty went through 15-16% correction, that was 5th worst correction of last 20 years. I mean, 15% correction is nothing. That is because Nifty is much more stable. But when you look at small caps and all, you can see that we are far from the mean valuation and we are almost hitting the 80 percentile value. And there's a big gap between these two. That means it's a more volatile. If your mean valuation is 20, your 80th percentile is 30. In Nifty, if your mean valuation is 20, your 80th percentile might be 23. That is how you have to read it. And we are far from the mean valuation in mid cap, in small cap, in micro cap. And in fact, in small cap, it is much, much higher. And the fundamental results also, what I showed you, that was taken from trend line. If we see that data, the mid cap was still performing very, very well. The large cap also have done well. The small cap results doesn't look good, at least at aggregated level, because index is a representation of aggregation. It doesn't look good. So again, to market, if market has to really perform from here for small cap and mid cap, the earnings growth need to continue. Else, the valuations are not in favor. It needs that dose of earnings growth. Else, it may not survive beyond 6 to 8 months. Now, looking at technical, so technical in Simba, we see that, you know, all the momentum indicators are on, everything is looking great. You look any index chart, everything will look great. So chart will weaken only when the momentum will break, and we are yet to go there. So again, if I go there and if I show you, the charts will come here. We are still in this phase. So only when the big money will sell, the chart will weaken. We have not yet reached there. So if we look at chart, everything will look great. So how we can look at chart? The other way to look at chart is, and there is a concept called, please go on mute. I hope no questions. So there is a concept called, oh, voice breaking. Okay. So there is a concept called selling in strength. And I think one of our community members, Himanshu, who is a great trader, he sells partially at strength. And now, how do you sell at strength? You sell at strength when things are too good and too stretched. So one way to analyze it is, let's say this is our weekly chart, and this is a 200-week kind of long-term moving average. How far we are from here? Now, again, see, there is no way to tell why 200, why not 50, why not 100. The idea is to catch the imagination of how much stretched it is. So if you look at it, and if we look at history, when charts stop, please be on mute. 1 second. So if we look at history of, again, this is for Nifty 50. From the mean moving average, 66%, 87%, 93%. These are super bull market run, 2003 to 7. And earlier from 2010, we never had such a high momentum bull run. Then we topped around 42%, 41%, 30%, 50%. So almost between 40 to 50% in a normal market, and between 66 to 90% in a super high momentum bull run market. We don't know what kind of market we are. Everything is done in the hindsight, but currently we are at 25%, this number. Again, by no stretch for Nifty 50, it looks like a stretch chart that any kind of top should form. I'm just trying to give you multiple views to explain how to triangulate all of that and have some kind of probabilistic view that where are we in the Nifty 50 cycle. The same data, if we look for the mid cap 100, because I don't have mid cap 250, doesn't have this history. Mid cap 100 has this history. If we look, And mid cap and small cap is a more volatile index compared to Nifty 50, both on the higher side and the lower side. So these numbers further go up in the super high bull market of 2003 to 8, 122 to 140%, and rest of the times in last 13 years, somewhere between 50 to 65%. Currently, we are around 45%. Now, I don't know if we'll revert from 50 or 55. We have to again think in terms of probability. If it runs further up 10, 15, 20%, we should not get surprised. But the more we are hitting that 55, 60 mark, the more we are getting in the high stretched zone. Time will tell if we are living in a decade of growth, which will be more similar to 10 versus 10 and 20 versus 3 and 8. Time will tell, but we need to keep an eye on the earnings growth rate also and compare in this decade what was the earnings growth and currently how is the earnings growth. But again, you can see this is in much higher froth compared to Nifty. And if you take this mean of 55, 56, 49, maybe the mean will be somewhere around 56. We are at 44. So maybe a 10-12% kind of move, but this line will also move in tandem. We have to see how it does. But somewhere between a 10-20% move, we might create froth on similar kind of EPS. If again quarter EPS growth rate comes, all the things are dynamic. We have to factor everything together. And if we look at small cap, much higher, 183%, and then 50, 60, 70, 58. Currently, we are at 40. So again, maybe again 15% more. Just on a stretching of chart because we don't see any weakness still on the chart. Fourth view, the sentimental view. We are using the Google Trend sentiment, looking for the words like multi-bagger, micro-cap, because that is where the mid and small and micro-cap plays happens, and the bigger volatility and the bigger froth happens. The good news is we are somewhere in the middle. First, the micro-cap was totally out of scene. Those who are in the market from 2017, you will know the stories of 2017 microcap, what happened, and many people lost their pants. But the 18, 19, 20, 21 bull cycle, nobody spoke about microcap. This 23 cycle microcap has made a comeback, and look at the kind of rise you are seeing in the Google keyword trends. And small cap, every cycle it has come. This was the 2017 cycle, December 17 when it peaked. This is January 22 when it peaked. Right now, after making a bottom, as market has made a bottom in March and going up, small cap index, this is also going up. If you look from here to here, it took almost 6-8 months. If you look from here to here, it took almost 8 to 10 months. Maybe again, we are 6 to 10 months away from the top. Nobody knows, but this is something which is worth tracking. So again, here we are 8 to 10 months far from this kind of a bull market continues as per this chart. The last view, I don't have a lot of idea about this because collecting this data and preparing this data, it's a humongous task, and I never had this hypothesis in mind. But recently on CNBC, data was shared, which is promoter selling in India. And looks like we had the highest promoter selling in India just in last 5 months. And this is the annual data. If this kind of 5-month sales continue, then it will be more than 1.6 lakh crore. Now, I don't know what to interpret out of this data because promoters sold in 2020 also, and still market went up. Also, I'm not sure if it is net promoter selling, which means buying minus selling, or it is only selling. So those data points are missing, but I have taken this more as a new hypothesis, which I would like to, go to my data labs and, prepare the data, do the experiment and see if there is any value. But that was another point I just wanted to highlight. So if we combine everything, quantitative momentum and price indicators, Nifty is in fair band and fair to high on price value map. Lower caps, mid, small, micro started hitting the froth momentum and high on the price value map with lesser chances of any kind of high double-digit return from here. The only thing which can work in favor is the EPS growth if it continues. Mid caps, large caps, very decent performance in Q1. Small cap, the number doesn't look good. I am little skeptic. I want to verify myself also by looking separately at small cap data, that is the growth was really that low compared to mid and large. Based on fundamentals, Nifty again in fair band. Lower cap started hitting the froth, strongly needs earning support. Technical, there's no froth even by the stretch logic. Lower caps looks all well, but a 10-20% further stretch. can create the weakness on chart. And though I am showing you the number of only to Nifty 500, we have a product called Data Insights as a service, which we call SIMBA, Scientific Investing Market Breadth Analyzer. And there we cover the whole market in much more detail at index level, sector level, industry level, company level. And we provide 1 month of SIMBA access, almost free at ₹1 token amount. So if you want to explore SIMBA, go and register to the SIMBA portal insight.scientificinvesting.in. Sentimental wise, 6-12 months looks more. So if we look at all of this, I think I have said that, riding the old money and investing the new money, they're two different things. My sense is we might be 15-20% away from the big top. If same kind of history repeats, we might be 6-8 months away from the big top. But earnings, if can surprise, then it might stretch for longer. So my key insights are: one, there is significant difference between Nifty and mid, small, micro cap in terms of froth. Lower the market cap, more are the chances of froth building. We have hit the 80 percentile by momentum heat map, but yet some distance away, maybe 3 to 8 months. It's anybody's guess. We need to keep monitoring fundamental, technical, quants, charts, everything. The continuation of the high earnings growth can surprise bears. However, we live on probabilities. We will go quarter by quarter. Charts are yet in full swing with no sign of weakness in small and mid cap, but with some signs of stretchness there. Charts on the level of stretch still 10-20% away unless we get a 2003-7 phase, because there the stretch was much more higher. But if we consider a non-2003-7 era, which means EPS growth rate will be somewhere between 10 to 15, then this number is there. Nifty chart not at all stretched. Valuation wise, Nifty not at all stretched, but all lower cap index have hit the 80 percentile mark. What I am doing personally, I will tell you, though I am someone who always likes to find ideas in every kind of market. Even 2-3 days back, I told, look at Amritanjan. I still posted about JVN Financial, 7 times less than 1 book value, all of that. Because, as an investor, you need to find ideas. You find whether you invest big money or not, the research is always on. But what I've learned is when the big market falls, it becomes very, very difficult for companies to perform, even if they're attractive. So I'm trying myself to calm down that no need to deploy new money as of now, or you have to be double, triple sure to deploy new money, however attractive you find the ideas, because the bigger ocean, especially in small and mid cap, they may not be in that kind of value zone. And market is small cap, mid cap is lot about liquidity. When liquidity dries off, nobody cares about valuation. Timing market to perfection is a futile exercise. We live on probabilities. They do not look in favor in mid, small and micro cap, but I don't know whether a top will get created in 3 months or 6 months or 9 months. So that is how I see it. A 5-15% kind of partial profit booking for cash or large cap rotation as of now, and then staggered plan based on how much the KPIs are further deteriorating and how much extreme we are further reaching, that will decide. But I think it's not a bad idea to, and usually I book these profits more in my trade portfolio first and then in my investing portfolio. But this looks like a tentative plan. Monitoring all this data on a monthly and quarterly basis is key, unless in between itself, the chart itself changed drastically and they give very worrying sign, which we are not seeing right now. Stretch sign we are seeing, but weakening sign we are not seeing. We need to keep checking the circle of investing cycle and keep looking for signals. So you saw when the valuations are stretched, it's a different kind of signal. When your historic price is stretched, it's a different kind of signal. When your charts are stretched, it's a different kind of signal. When your charts will start getting weaker, it's a different kind of analysis. Then you need to really do the chart analysis. And when the liquidity dries from the market, I have still not discussed a single indicator about market liquidity, because still which indicator to be applied in which phase of market, I think we are still a little away from look at it. The moment the chart show first sign of weakness, I will start going and looking at my liquidity data and all. So we need to keep looking at the right data at the right stage and keep looking for signals when they play one by one. So that is, I say, people get very excited. They think ये हो गया तो अब सीधे ये हो जाएगा. You have to go phase by phase. That might happen slowly, that might happen fast, but as and when it happens, we need to react. Be very selective in investing. Evaluate the portfolio quality and valuation if you are mid and small cap investor. I think that is important in next 3 to 8 months. Trading, keep respecting stop loss, especially people who are new and they get excited. When our investing cycle tops, all junks we trade, if you are not exiting, it will lead to 60-70% losses in portfolio and will be very, very difficult to recover, because it will take a 300-400% performance to come back to the price at which you have purchased. So anybody who is trading, please respect your stop losses. Market can forgive you when it is in uptrend, but the day a bigger investing cycle tops out, you will have a lot of losers in the portfolio if you are not exiting, and that money will get stuck for years. So keep respecting the stop loss, and if you cannot take stop loss, you have no right to trade. And there is nobody who doesn't go through losses. I mean, 60% is a super good accuracy. There are other ways. I mean, I don't want to talk about quants, but that is very, very important. Unless you don't learn to take losses, it's very difficult. Never ignore the possibility of outlier. I know that last 17 years it has been like Bhediya Aega wala story. People come on TV and they say that this is going to be the biggest bull market, right from when BJP came into power. Uske baad ye aega, wo aega. Still, we have a decade story. Never say no. It can always happen. What happened in 3 to 7, I think that was one of the most massive bull runs I have observed, at least as just a normal guy who was in a job and participated in 6-7. I have not seen before 2000, but in my mind, that is the biggest bull market cycle. It can always play out, and those kind of outliers can always keep valuation stretched. So be ready for all kind of scenario, manage by tracking and all, but manage your portfolio and cash based on the probabilities, not in binary key. Okay, market top, I will go in 100% cash, I'll go 100% in. At least I don't do like that. I do in probabilities, and that is what I can share with my experience. So I'm done. I'm opening it for questions.